Hi, welcome to the Market Alert for Tuesday, the 21st of April 2020. So the market is breaking everywhere. No surprise if you followed the Market Alert for the last 10 years. We're really starting to see things fall apart now as we head towards some sort of reset. The money printing is off the charts. There's scheme after scheme by governments, all which, I hate to say it, will not work in the long term. And that's purely and simply, you cannot continue the same madness of printing and getting the same result, which is zero growth, which we've seen for the last 10 years since the great financial crisis. And yet this continues, but more on that as we go through what's going on. I mean, yesterday we have a major problem in the oil market. In all of the years following the financial markets, I have never seen this where the nearby futures contract actually went negative, minus $37 per barrel. And it's purely and simply because there is absolutely no demand. I mean, you can see the chart here. When you've got 3/4 of the world in lockdown, nobody really going anywhere in their cars. As simple as this, there is no storage left for crude oil. And of course, the effect there is the demand disappears, the supply increases, nobody wants it, and you end up in a situation where there is just more oil than there is demand. Never seen this before. It's going to be interesting to see what happens in the June futures contract. But the best explanation of this, because I don't want to go in and spend 25 minutes in his video talking about this, is to have a look at Mike Maloney's video on Oilmageddon, which explains it in far more detail. He just focuses on that. So I'll add that into the email link and also probably in the description below as well. But I've never seen this before. This was no surprise, I suppose, in one way, given the massive drop in consumerism, in demand for all things. And this isn't going to be over in 5 minutes. I don't know why. I speak to people and they think that as soon as the government lets us out, they're going to be back to normal. And it's just complete delusional thinking. There's no way are we going to go back to normal. This is the new normal going forward, certainly for the next 2 years. But and of course, you're not being told all of this anyway. I mean, anybody that has followed me for the last 10 years knows exactly where this leads to. And that's why I recorded the series of 3 videos and do a daily alert, just to keep you up to speed with where things are actually going. One thing that was surprising yesterday was how resilient the market was. Well, surprising, not really. Let's face it, we know the stock market has been rigged for I don't know how many years now. Well, certainly from 2008 when the Fed, that is, started printing money, and it found its way into the shadow banking system and then straight into the stock market, creating asset bubbles. That's part 1 of the end of the financial road that discusses that. But yesterday, surprisingly, the market moved lower. It closed back below the 62% retracement. This is the Dow Jones, and I'm surprised. We're down on the overnight, but there is a rumour about Korea's president, whether he's ill or not at the moment, so they keep oscillating back and forth. It just shows you how it's how it's become. It's laughable, really, that the futures market of the stocks of the underlying companies is now based on whether the Korean leader is ill or not. But yesterday in the main event from 2:30 to 9 p.m, the market managed to move back to the upside, having in the electronic market move lower, which you can see there, having closed below the 200 MA. Prices moved sharply lower by 100, 200, 300 points before, as you'd expect, the market was brought back. But then around about this time, crude oil started to fall off a cliff, or the prices did, and this sent the market all the way back to where it had started, well, a bit lower than where it started in the electronic market early hours of Sunday night. So now you can see, again, we've got a bit of a shakeout in the stock market. But because of the disconnect between reality and the stock markets, i.e. the massive slowdown in global trade, GDP figures of minus 35%. That are forecast. The stock market is holding up well, but that's because of the trillions that have been printed already by the Federal Reserve and pumped into the markets to hold them up. Eventually, when it stops working, because it always stops working in the end, you can't borrow from the future to keep doing this. The whole system will return to fair value. It won't be pretty, but that's going to take some time before this happens. In the meantime, they're going to do whatever they can to hold the stock market up. It is the last remaining vestige for the masses to actually see that, well, everything can't be too bad if the stock market is still up, and that's not true at all. So yeah, that's how the market reacted. At the moment, it's very steady, as we can see there in the weekly chart. We're down back through the 50% retracement, and the monthly chart back through the 50% there as well. So we'll have to see how this holds up, but get ready for more money printing this week. We've got the unemployment figures, another forecast of another 5 million job losses this week. Today we get the claimant count change from the UK. This will be an interesting one. They're forecasting 170,000 job losses, previous 17,000 there, but we'll see. If it's like the US, they forecast 3 million. It came out at 6 million. They could be off quite a bit. But this is going to get worse going forward. This is only the first month since the lockdown that we're seeing these figures reported this morning. What time was that? Just to remind myself, 7 a.m. So not too long to wait for those. And other news, let's have a quick look. Here's the problem. 100 million barrels get delivered. What happens next? As like I say, the demand for crude oil has fallen off a cliff. And like I say, really, crude oil and the stock market tend to be work together, which, of course, like I say, there is that disconnect because the Fed is buying everything. The only thing the Fed isn't buying at the moment is stocks. Well, not officially. They could be behind the scenes. I mean, they've propped the banks up again. They're buying junk bonds, they're buying ETFs. It won't be long before they're actually buying stocks, as Japan has done, which I think owns 3/4 of their stock market. So it just goes to show you what these central banks are really up to. 30% is conservative when this does go. Like I say, for me, it isn't going to go for the time being. I can't see it because of the trillions that the Fed has printed. And even here in this headline, oil producers will pay you $54 a barrel to take South Texas sour off their hands because there is no storage. And they have to pay for storage, so they'll pay you to take it because it's cheaper to have somebody else take it than actually pay for the carrying costs and storage costs. Incredible. Let's have a look at Bank of England as well. It's about time we had a bit more on the economic news in the UK. The fear mongering with COVID has been unprecedented, off the charts. People living in fear. Look over here. You could die from this, and I'm not trying to diminish this in any way, shape, or form, but the power of the media is what I'm getting at. You look over here while we distract your attention away from the from the collapse of the economy. So, as it says here, Bank of England boss checks hopes of bounce back after economic crash, said this: there is not going to be a V-shaped correction. What we mean by this is that all the prices drop and then they bounce back. That's not going to happen. No way on this planet is that going to happen. And as the Bank of England governor says, British economy may be heading for its worst 3 months since comparable records began. 3 months is optimistic as well. Plunge of 35% GDP. You do not bounce back from minus 35% GDP in 3 months, in a quarter. That's not happening. So, he was referring to the OBR's figures, which they put out last week. And that was funny because that had actually it wasn't even a V-shaped correction. It was like down for this quarter and then straight back up. That's not happening. It is not happening. Simple as that, because of the debt, the global debt. You see, everybody's talking about all of these other things, but nobody's talking about the amount of debt. There was 250 trillion global debt. It's increased by 50 trillion in 10 years. And you only have to look at the Fed's balance sheet, which we do. And I'll have a look at this tomorrow. When you see that in the last week they printed over 285 billion was added to the Fed's balance sheet, buying toxic assets. And that was the amount of money they used from, I don't know, the inception of the Federal Reserve in 1913 all the way up to 2008. There was only 285 billion debt on the balance sheet. Now it's nearly 7 trillion. And most of that's been put on in the last few weeks. So you can see that the madness of printing, trying to cure the problem of debt, adding to debt. It's like having a credit card and just keep adding to it in the hope at some point you'll be able to pay it off, which obviously you can't. Unbelievable. And like I say, the news is now starting to come through. Virgin Australia in voluntary administration. So that's Branson didn't get bailed then. Oil prices plunged to zero. 140,000 firms apply for furlough scheme. This is an interesting one as well. That's the companies. This money is going to run out very quickly, if not by the end of today, that was made available by the Treasury, because, again, underestimated. It's a very expensive way for the taxpayer of keeping people in their jobs. I'm not against it at all. The last thing I would wish to see is anybody losing their job, their home, and whatever. It's bad enough as it is. Again, the government are going to have to continue to print. They also, as you saw in the Market Alert, issued a letter a couple of weeks ago about the Ways and Means facility at the Bank of England, where they circumvent the secondary market. They don't go to the bond market to borrow the money. They print it direct, which is monetizing debt, which is hyperinflationary down the line. Not yet. You've got to go through a depression, stagflation, and then all of a sudden, because of the flow of goods and services has been hampered by the virus and the global shutdown, you will then see hyperinflation in consumer goods, i.e. food, is what I'm talking about. You can see job losses. Primark strikes 370 million deal with suppliers, and again another Baker there in administration, and you're going to see a lot more of this. There is no quick recovery from shutting the global economy down, and the government has still given no exit strategy, no exit dates for the lockdown. So again, as going forward, it is only going to get worse, unfortunately. But there's not a lot that we can do about this. But on a lighter note to finish with, Mr. Kipling is doing exceedingly well as retail navigates the crisis. I mean, why not sit at home? If you're staying at home, then why not have a Mr. Kipling's cake? And on that note, I will see you in the next one. Lots to try and pack in at the moment. We'll have a look at the Fed's balance sheet tomorrow, and the continuing printing of debt and the potential effects that this is going to have going forward, unless, of course, something else happens today. We have got the expiration of the crude oil futures contract today. It'll certainly be interesting to see how this pans out. Okay, that's it for this one. As ever, thanks for watching. See you in the next one.